That's not a soft landing. That's the market saying, in very technical terms, in very high level terms, interest rates are going to go lower. And why would interest rates go lower? Well, let's ask Mr. J. Powell. Because remember back when the U.S. Treasury yield curve first inverted in this cycle, it was March of 2022. And it was the 2-year, 10-year spread, which is the one the public knows enough to watch and associate with recession for good reason. But Jay Powell said, no, forget the 210 spread. I know that's the one everybody watches, and I know there's a correlation, but we sophisticated economists, we don't use the 210 spread because why would we? We have our own sophisticated way of looking at sophisticated things, using sophisticated analysis and coming up with sophisticated interpretation. And our sophisticated interpretation says, forget the 2-year, 10-year, use something called the near-term forward spread. That's what us great economists use. We use the near-term forward spread. And as Powell said last March, that's really what has 100% of the explanatory power of the yield curve. Notice he said 100% of the explanatory power of the yield curve. It makes sense because if this part's inverted, that means the Fed's going to cut, which means the economy is weak. Right on, brother. Preach it. That's exactly right, Mr. Powell. Once the Fed starts cutting rates, it's not a good thing. That's a bad thing. It's because, in his own words, the economy is weak. And he's about to eat his words. Because after saying the near-term forward spread has 100% the explanatory power, spoiler alert, guess what happened a couple months ago? The near-term forward spread inverted. Minus 73.6 basis points as of January 6th. And what the near-term forward spread means, or what it is specifically telling us, is that the expected 3-month interest rate 18 months from now is 0.75% lower than it is today. 0.75% lower 18 months ahead. So you can understand why Jay Powell would say it has a lot of explanatory power. Number one, it's telling us that the market is saying interest rates are going to go lower, which is something that we hear all the time. Not only that, look at when these changes took place. The steepest part of the recent cycle for the near-term forward spread was June 13th. So it began to fall off June into July, just like everything else. And then it fell off and turned negative for the first time back in early November. In fact, a specific day in early November, the day the October CPI came out, the one that which triggered for the marketplace the same reaction we see across Germany and other places. It was confirmation of what markets have been expecting all along, which is consumer price and producer price pressures were going to come down, not because of successful policies, but because they had gone too far already. They had created too much demand destruction, too much economic pain for the economy to continue. And as the marketplace continues to plot lower interest rates ahead, remember what Mr. Powell said. What has 100% of the explanatory power of the yield curve? 100% of the explanatory power of the yield curve says Jay Powell is 100%, well, it's never 100%, but as near as 100% as a uncertain dynamic world can produce that kind of certainty, interest rates are going lower. And if you go to neartermforwardspread.com, what you see in the short paragraph explaining it is this sentence. The near-term forward spread is a good indicator of the future stance of monetary policy as well as recessions because of what Powell said. Those two things are linked. The Fed cuts rates because things in the economy as well as the monetary system and likely financial markets are not going so well.